ONGC is down, RIL is down, All India is down. Manish Sonthalia joins us, Director and CIO Head of Equities with Motilal Oswal Securities. Where is the umbrella? It's raining in Bombay. You managed to reach on time for the interview and you're looking completely dry. How did you manage it? Please share.
For a change, you know.
For a change on time or for a change that you managed to reach dry?
Both.
It's good to have you back. Crude is down 20% from the recent high, 10% last night. How come that is not getting translated into excitement? When crude started going higher, everyone thought that this is going to be the biggest cross. But now that it has reversed and technically crude is in a bear market, why are Indian markets not doing cartwheels? What is the other concern left now?
Yeah, so Nikunj, broadly, we actually know that unless and until US market bottoms out, India markets will not bottom. I mean, that's a given. Now, US markets are likely to bottom out only when, 100% of recession or no recession is priced in. Now, given the situation, how industrial metals have corrected, given the thing that the inventories of natural gas supplies in Europe, etc., have shot through the roof, all of this, tells you that a lot of recession has already got priced in. To what extent? I mean, it could vary between 50 and 80%. I would reckon something like 70-80% of US recession is already priced in. Now, and this is basically manifested in the fact that from 15,200, we are now at 16,100. So a lot of the positivity has really got priced in. 20% of probability of recession has not yet got priced in. That leaves us with a lot of volatility, in the months ahead, maybe next 2 quarters, or not next 2 quarters, maybe next 1 quarter. All of that 100% of recession or rate hikes will broadly get priced in. So, it's not that Indian markets are not seeing the positive aspects of correcting crude prices or correcting industrial metal prices. We have bounced back from 15,200. And it's likely that, benefits of lower cost of crude energy and metals, commodity prices will be felt in the earnings numbers going forward. Valuations are very benign. So from that aspect, I think there's little room on the downside, but more room on the upside.
Are you happy that autos have come back or feeling slightly sad that IT is down because you own both?
Yeah, so, we have really not sold anything in IT broadly, just a bit of a tinkering in percentages here and there. So that tells us that, I'm really quite positive about the IT space going into the future, next 2 years. Markets are really worried about the near 1 to 2 quarters in the form of compression in margins. Commentaries from companies which have reported numbers so far seems to be quite positive, at least on the demand side. We really got to figure out whether FY24 numbers would result in double-digit revenue growth, or whether for the sector as a whole it would result in single-digit revenue growth, because other things, which is other levers like pricing, is really going to improve. I mean, that's my belief, given the demand situation, and attrition will also ease out over the coming quarters. That would mean that with the valuation compression, literally all the stocks have fallen by 40-50%. You have ample valuation comfort, because bulk of profits of corporate India is basically coming in from the IT sector, 15% types. If you believe that 10 lakh crores was the corporate profits for FY22, and that was the actual number, 15% of profits were generated by IT companies. It's a sector we can't be ignored. And I think if not an overweight position, at least an equal weight position is warranted. It is a good buy at current levels. Autos, this was all in the making. We really believed that these commodity prices would cool down in the medium term. So what were headwinds in the form of higher raw material costs or higher gasoline, diesel prices really, is now acting as a tail. We all know that demand situation is quite robust. So, earnings growth will come through from the auto space. In fact, the mantle of earnings growth for FY23 is going to be lifted by your banking, your IT, and you have automobiles. These are the three major sectors. And another major sector would be your capex related names, the industries.
I want to just talk a little bit more about these capex related themes because the last time we saw this overall capex thrust was 2009-11, and then there was quite a long lull. So you are seeing that clear shift coming back to the capex cycle. What is it that you're expecting in terms of management commentary or in terms of earnings from these capex related companies? Do you think that we will see that acceleration play out over the next few years?
See, look at the capex announcements that you've seen from two major sectors, steel and cement. That gives you some sense on how the capex is shaping up. I think this sort of a thing, thanks to Atmanirbhar, China Plus One, PLI, and all of that, will result in a lot of capex, and this has manifested itself in the form of order book positions of companies. Near-term challenges are actually margins and working capital. Of course, with the rate increases, all of this will get priced in. And from that point of view, if you talk about the longevity of growth, and based on our understanding with companies which are leaders in this space, we think there is a long runway in terms of capex recovery that is yet to play out. I mean, one must not forget that India today has 15-year low on corporate leverage. You rightly said that post global financial crisis, really not too much of a recovery in capital formation have had happened. So right now, when we are talking about very little leverage on corporate balance sheets, that gives us, and the demand situation in terms of deglobalization, indigenization, this all gives you a broader picture about how the capex theme is likely to play out. It does make sense to actually have some quality names, in the portfolio, and not to forget the automation, the IoT, industry 4.0. All these things are really, some leading indicators as to how the capex related things like.
I wonder if you have any opinion on, some of the aviation or hospitality related sectors or even multiplexes. It clearly seems that the COVID-related concerns are behind us. We were discussing earlier this morning. Now it's something that we have to live with, and we're seeing places that are packed across the board, airports as well. People are jostling for space over there. So is this likely to be a strong theme that had seen, had been beleaguered for a very long time and is now likely to see a convincing comeback across the board, Manish?
So let's talk about aviation. Yeah, flights are full. There's a lot of demand. Occupancies, is very strong. But still, if you look at the loss which aviation companies are making, it really doesn't make too much of a sense to invest. You could be having trading plays in the aviation space. You have companies which are leaders, more than 50% market share, so on and so forth. But at the end of the day, aviation companies are not making money. They will be in for raising fresh rounds of capital. Now let's come to the hospitality sector. The same story out there. ARRs are through the roof. RPOBs are very strong. It's likely to get stronger into the second half of this year. But at the end of the day, someday the normalization will happen, and post financial year 23, all of these high numbers will be in the base. And from that level, we need to figure out as to how the demand and supply of rooms are playing out in all parts of the country. You have some names in this space will look like somewhat of structural trends over the next, positive structural trends over the next 2-3 years, but not any longer than that. But currently, you're right that this space is having a major tailwind in terms of occupancy levels, in terms of pricing power, the RPOPs, average revenue per occupied room. These are all very, very strong currently, and they are likely to benefit even going into the second half of this year.
Good morning. This is Nayantara joining in the conversation. Since we're talking about aviation, the entire reopening trade, I wanted to talk to you about the fashion stocks. I know you've been bullish on Vedant's fashion in the past, especially after the IPO. You've been talking about it. Are you still as bullish?
Yeah, absolutely so. And I'll just give you a small thesis as to why we are looking at this space quite strongly. I mean, you see, 1 crore marriages in India is a given that we have 1.4 billion people, right? It's a 10 lakh crore spend annualized market, the marriage market, and 15% of that is spent on apparel. So it's a 1,50,000 crore apparel market, the wedding and celebration, of which 1,30,000 crore belongs to the women's space and only 20,000 belongs to the men's space. And this is till now and till very recently was a totally unorganized space. Akin to how Tanishq created a brand out of an unbranded space is Manyavar, which is having a 40% market share in the branded space, which is 25% of the total men's apparel celebration wear spend, which is 20,000 crores. The total branded market is 5,000 crores, of which they will have roughly 40% market share, which is 2,000 crores. Now in apparel, retailing, fashion, anything, if you get your unit economics right, there's a long runway to go. India is a huge retailing market, 65, 70 lakh crores of spend that happens on the retailing front, whether it be V-Mart, your groceries or D-Marts or Trends, you name it, beauty, Nykaa, everything. If you get your unit economics right, and that is ROCs at the store level being more than cost of capital, and then it's all about the growth that you can anticipate. So my sense is, these guys are actually having very high gross margins of around 75%, EBITDA margins of 40%. You just got to have a handle on growth. And my sense is going into the near future and even going into the distant future, there's a lot of terminal value which is still sitting because 75% of the market is still unbranded. And please don't forget that the entire women's space, which is a 1,30,000 crore market, of which they have also launched their Mohe brand within the women's space, launching Alia Bhatt as the brand ambassador. That's a total option value. Unleveraged businesses, 65% ROE, 25% growth. They will likely double their profits in the next 3 years, sitting at around estimated profits of around 400 crores in FY23. So I think this story is akin to a Titan. This story may be akin to a Page Industries where we have high dividend payout ratios, high ROEs, and a long runway for growth, a lot of terminal value. So I think this is one space which looks very
One of your multi-bagger ideas, Vedant, you have been bullish on that stock. The IPO price is, of course, 866, the current market price on the screen for all of our viewers. So, Manish, since you brought up beauty, fashion, what all ladies love, you also spoke about Nykaa. What's your call when it comes to Nykaa? The stock is down 30%. And at a time, you're also talking about consumer stocks and all of these kind of stocks when the markets are trending towards what? PSU banks, PSU stocks, towards value stocks.
So in India, only growth works. Yes, there are periods when value, stocks do well. And FY23 is one such year where value stock will likely triumph over growth stocks because a lot of growth sits in the terminal value and cost of capital is going up. So obviously, the NPV on growth stocks is likely to come down. It's getting manifested in the prices. But there will come a point in time when, growth will again start to play ball. And we've seen a lot of wealth creation happen only through growth stocks. Coming to Nykaa, I think we have seen some sort of a correction. They are doing quite well in the BPC segment, which is the beauty and personal care. They have a right to win there. And, as was talked about, any unit economics which is favorable in the retailing space and you get your unit economics right, markets are very generous in giving you roughly 10 times sales. You look at D-Mart trading at 10 times sales. You look at Trend, it is 10 times sales. You look at Manyavar, it is 10 times sales. You look at Go Fashion, again 10 times sales. Similarly, Nykaa gets its unit economics right in the BPC space, roughly trading at 10 times sales, 70,000 odd crore market cap. So, and around 7,000 crores reported numbers on the GMP, the sales part. So I think a lot of growth for Nykaa is likely to come from both the spaces, the fashion space as well as the beauty space, the apparel, clothing apparel space. They have minuscule market share. Within the online share, they are roughly around 30%. The market, the TAM itself will grow many-fold going into the future. So it's a play on how the growth plays out and how the EBITDA margins are likely to share.
Right, and that's something we'll be watching out for, Manish. Appreciate your time. Thank you so much for joining us with your market outlook.